In this lesson, I'll be going over something called market pattern recognition, or some people call it market formations. Now, these are sort of patterns that, occur over time. Basically, going back to, the words of history repeats itself. So these are patterns that happened before that will most likely play out the same way. Now, you get three types of sort of market pattern recognition or market formations. And then within these three sort of types, you get different, types of market pattern recognition. But let me go through them. So, like I said, right, it's patterns. Market formation patterns are patterns within the chart, okay? And these sort of patterns or these sort of market formations, they tend to repeat themselves. So, as us traders, we can take advantage of this repetition. Now, the thing is, if you identify these patterns correctly, okay, there is major profit potential to be made. Like I said, there's three main groups. Okay, first group is continuation patterns. Second group is reversal patterns, and third one is bilateral chart patterns. So there are different types of patterns within the three groups. So I'm going to be going through the three groups with their several sort of patterns. So the first one I want to get through is continuation patterns. So before giving you the types of continuation patterns, I just want to explain it a bit more. So for continuation patterns, these are basically giving you signals that the current trend is continuing. So if we're in a bullish trend and one of the type of continuation patterns occur and it's valid, this means that the trend is going to continue bullish. So you'd still want to, have buy positions open. Same with the downtrend. If, price is going down, making lower lows, lower highs, and the continuation pattern, forms, then and if it's valid, remember it can happen, but it won't be valid. Okay, so if it's valid, then you are still looking for sales because it's most likely going to continue. It's mainly consolidation patterns because it shows the buyers or sellers are taking a break before continuing. As you should know by now, a trend doesn't move in a straight line, so it just doesn't go one way. Okay, it makes your trend, it makes your higher highs, your higher lows, your lower highs. So it's sort of like a wave. It goes up and down, or sort of like a staircase. I mean, if you look at a staircase, climb one, going up in a staircase formation, should I say? All right. So what are the examples of continuation patterns? So the first one is a rising wedge. Now, as you can see, this is sort of a cheat sheet. I mean, you can pause the video, screenshot this, print it out, put it on your wall, whatever you do, just to like familiarize yourself with the type of patterns. So I gave the pattern name, I gave where it forms in, okay, what direction does it form in, and then what's the next move, okay, and then what it looks like. So, for example, the first one, rising wedge, that's the name. Okay, where does it form? It forms during a downtrend. Next move, it's going down because it's a continuation pattern. And then that's what it looks like. So let's go on the chart quickly. Now, basically with a rising wedge, you'll have a big move to the downside, so a big impulsive move to the downside. And then what will happen is it'll make a lower, sort of, a lower high. And then it'll make a higher low. Then sort of, like higher high, higher low. And like the moves will get generally smaller, something like this. Okay, it'll sort of look like a triangle. So if you were to put, your trend lines, for example, something like that, and something like this. So can you see from being big move, it goes smaller and smaller and smaller up until the point it'll break past. Now, basically for me, I wouldn't just sell on the break. A lot of people just sell on the break. Uh, I like a lot of confirmation. So what I would do is I'll wait for, this low to get retested, or just the trend line itself. So I'd wait for price to break low, make a lower low, and then for it to retrace back up here, or the trend line itself. Put Fibonacci, candlestick confirmation. There's a lot of, other confirmations that you can use. And then from basically this point, I would then look to sell and then catch the sell because it's a continuation pattern. Let's see an example, with the candlesticks. So here's an example on USD CAD, right? It's not a perfect example, but remember, we're not always going to get the perfect moves. So as you can see here, from this point, from this point, so from this lower high, pushed right down to make this lower low, made this lower high, made this higher low, and then higher high. Okay, so if I remove these drawings and I put trend lines, okay, so that's the first point, there's the second point, okay, and then at the bottom, here's the first point, here's the second point. So as you can see, this is a rising wedge. So, here's the breakout, formed the lower low, came to retest, lower high, and then over here you would have sold, which you can then, then you can see you would have made profit. This was, okay, but remember this is a daily time frame, so it's no point in talking about pips. I mean, 640 pips, that's a ton, loads of pips, on a currency pair. But I'm referring to, the market formation itself. So that's basically, how it would work out for a rising wedge. Right, the next one is the complete opposite of a rising wedge. It is a falling wedge. So as the rising wedge comes from a downtrend and it's a continuation move, so it goes further down, your falling wedge comes from an uptrend and it goes further up. So as you can see, the photo on the right hand side, it is complete opposite to, the rising wedge. So with a falling wedge, you'll have a big move to the upside, and then you'll have something similar to this. Something like that. And then what will happen is your trend line descending. This can be ascending or sort of like, a descending triangle. So similar to that. And then, you can expect price to increase. But like I said, I would wait for a breakout, makes a higher high, comes down for the retest, and then I would look to buy. So let's have a look at an example on the chart. So as you can see here, casual big move to the upside, and then we have a move to the downside, that, and like that. So if I remove this and we put a trend line from this major one, see if I put it there, it wouldn't make sense. So here, like that, and then your next one, keep forgetting that thing. Next one like that. So as you can see, price broke out, made a higher high, came to retest. Okay, retest. I mean, you can put like, let me show you example. Fibonacci from there to there, 78.6% bullish engulfing you buy. So you know you got your market formation, you got your market structure, you got your Fibonacci and your candlestick, you know, bullish engulfing. So price is most likely going to go higher, which you know it did for a little bit. If you look at the daily from that open, you know, yeah, it's like 800 pips. So that's a falling wedge. Next, continuation pattern is a bearish rectangle. So it's similar to, you know, a rising wedge, falling wedge. They're all similar. It's just now with the bearish rectangle, it's a block. It's a rectangle. It's literally a consolidation period. It's not, you know, got increasing or decreasing. It's just solid. That's it, and then a breakthrough. So let's have a look. So with a bearish rectangle, okay, you'll have your bearish move, lower low. You'll have a lower high, then an equal low. And remember, guys, this doesn't have to be exactly an equal low. It can be just short or just, you know, on. But this is the perfect market structure. Market formation, sorry. Equal high, equal low. Remember, it can go up until this point, maybe like that, and still, you know, be. That's why, you know, would look at the zones rather than just a normal line. But this is what will happen, and I mean, what you'll have is sort of like a resistance there, and then sort of, you know, like a support here. So, you know, some people call it a bearish flag. Okay, looks like a flag. He has the flag pole, and then you got your flag, bearish rectangle. So then what will happen is, you know, price will then break through. You wait for the retest, and then, you know, sell. So let's have a look at an example on the chart. Where did I have it? I think this was the example here. Okay, it's not 100%, but I mean, if you look at this move here, from that move all the way down, and then you got this consolidation period. I mean, if you were to take your, like that, and like that, as you can see, breakthrough, retest, sell, and you know, price. Okay, yeah, wasn't perfect, but as you can see, price did decrease. Obviously, if the, you know, the consolidation is not perfect, obviously the rest of the move won't be that perfect, but nonetheless, it was valid. You know, it decreased, it sort of consolidated. Um, that's a bearish flag, bearish rectangle, whatever you want to call it. Now, for the bullish rectangle, it's complete opposite to the bearish rectangle. It's just this time it's in an uptrend, and the continuation move is to the upside. So as you can see the picture on the right hand side, it's very similar. You know, bullish rectangle, bullish flag, whatever you want to call it, still stays the same. Now, the bullish rectangle or bullish flag, okay, it will have the upward move, make a higher high, then it'll make a lower or high low, sorry, equal high, equal low, equal high. Okay. Now the amount that it can make, it's, you know, no one knows. It can make 2, 3, 4 equal highs and lows. Just depends on you. and the breakout, So then you have your trend line there and another trend line over there. So that what will happen is you would wait for the breakout, make a higher high, come down to retest, and then that's where you'll enter a buy because it's most likely going to increase. So let's have a look. The example I'm going to show you now, I personally wouldn't trade this example because it's too small. So remember, it's just I'm trying to give you the concept of how it looks, and the criteria of it. So like over here, you'll have your big bullish move to the upside. Then you'll see that it will make higher low equal high equal low. Okay, yes, remember I'm looking at the bodies over here because I know some people say, oh, but that's a high low. You need to think of it as zones. So if I remove these and I put a zone over here from that high to that low, drag it, and then from this low to that high. Okay, as you can see, boom, boom, break, retest, sort of like a morning star or, three soldier, whatever you want to, whatever pattern you're looking at, Fibonacci, and then you would buy, and then, okay, price didn't go far this time, but remember, this move was short, so obviously the upward move would be short. Okay, it's just common sense. So hopefully, you would want a more of a kind of move like this, where, it'll be more consolidation and then the breakout, because then the move would be longer. And then the last two for continuation chart patterns is your bearish pennant and your bullish pennant. Now this is similar to sort of your rising wedge and your falling wedge. So I'm not going to do the examples like I did. It's practically the same thing. As you can see, your bearish pennant, it makes a lower low, makes a lower high, then a higher low, okay, then a lower high, higher low, lower high, higher low. With your bullish pennant, makes a higher high, higher low, lower high, higher low, lower high, higher low, and then it should break above. So onto now, a lot of the patterns that occur comes from your reversal pattern. So there's more sort of reversal patterns than continuation patterns. These are more accurate and they occur a lot more often than your continuation patterns. So your reversal charting patterns now will indicate that there's most likely going to be a change in the trend. So if we're in an uptrend and a reversal sort of market formation pattern occurs, you know that it's most likely going to turn into a downtrend and we need to start looking for sells. The same if we're in a downtrend, price is making lower lows and lower highs, and then a reversal pattern occurs, then we're most likely going to look for buying opportunities because it's about to reverse. Now, buyers are taking control over the sellers, okay, from a bearish reversal, and sellers are taking control over the buyers in a bullish reversal. So here are the sort of reversal pattern. So the first sort of reversal chart pattern is a double top. Now this double top occurs in an uptrend, so the overall price movement is going up, and once the double top is valid, then we should look to go in downwards. So it's a reversal, so we need to look for selling opportunities once the double top is valid. So let's have a look on the chart. For a double top, price makes higher highs, so a higher high, higher high, higher low, higher high, and then let's say price makes a higher low and then comes to this level, this area. Remember, it is an area, so it's not a line, so it can either come just above or just below and it's still valid. So then price will reject, come past this higher low to form a lower low, come up, retest, and this is where you sell. Now, let me show you. Price makes a higher high. Higher low. Continues to make a higher high. Continues to make a higher low. And then this happens. Price makes a equal low. Equal high, sorry. Equal high. And then breaks this higher low to form a lower low, indicating sellers are in control now. So potential downtrend. And tops it off with a lower high. So as you can see here, triangle. This here is your double top. Over there. This is your neckline. This is your neckline. So you'll look to sell here. Because number one, market structure told you it's bearish. Number two, it's the break and retest of the neckline of your double top. You put your Fibonacci, etc. Candlestick confirmation, support and resistance, and you look to sell. So here is an example of a double top. So I'm just going to start here, higher high. Okay, there's your higher high. Here's your higher low. Higher low. Here's your equal high. Equal high. I can't. So here is an example of a double top. So price makes higher highs, higher high, higher low, higher high, higher low, higher high, higher low, and then makes an equal high. So indicating a potential reversal. Boom, lower low came for the retest. So as you can see here, let me write it out, higher high. Okay, here's a higher high, here's a higher high, higher low, higher low, higher low, then price made a equal high, equal high, then formed a lower low. So now we wait for this retest up. I mean, look, here's your neckline. Okay. So retested the neckline, formed your lower high. Okay, you can put your Fibonacci, put your trend lines, everything. But this is where you would look to sell. As you can see here, you would have profited. So that is a double top. With a double bottom, price will make a lower low. So it'll make a series of lower lows and lower highs. Then what will happen is price will fall, like make an equal low. Now remember, it is areas, it is zones. It's not, you know, it can be exactly like this. It can just be above. It can just be below, somewhere there. Okay. So it makes an equal low, then pushes above, breaks, makes a higher high, indicating buying opportunities, uptrend, right? So we wait for the retest on the neckline. Okay, double bottom has a neckline, and this is where we would look for buying opportunities over here. Okay, why? So let me write it down. So we have a series of lower lows and lower highs. Whoopsie. Okay, lower lows, lower high. Then we had an equal low. And then price broke up past this lower high, giving a high because this high is higher than the previous high. So this here is your double bottom. So here's your neckline over here. So price formed a higher low, and that's where you'd look to buy. If I use a triangle, let me show you your double bottom. Okay. So it's here. Some people, like I said, call this the W formation. So here's where you would like to buy. So if I show you above here, so as you can see, price has made lower lows and lower highs, and then over here made a lower low, lower high, equal low, pushed right up to make a high high, came down to test as a higher low. So if I write down here, lower low, lower low, lower low, lower high, lower high, lower high, equal low. Then price pushed above, boom, made a higher high. And then came to retest down to make a higher low. Now how could we know that would have been where we want to enter? I mean, here's your neckline here, remember? Over here. So, broke your neckline, retested your neckline. I mean, you could put your trend lines here. Broke your trend line, came down to retest. Fibonacci, 61.8% Fibonacci. This is a Morningstar candlestick pattern. So that's where you would have bought. And as you can see, price increased. So that is a double bottom. Now the most common sort of, reversal pattern is your head and shoulders. Now, head and shoulders happens in an uptrend. Okay, next move is a downtrend. Now it kind of looks like, head and two shoulders. You got your left shoulder, you got your head, and then you got your right shoulder. Next move is down. So this type of pattern also has a neck. So, we always have to wait for the retest on the neckline before, entering the sell. Let's have a look at an example. A head and shoulder is basically turning a bullish uptrend into a bearish trend. So it's a trend reversal. So what will happen is we'll have, let's say, higher highs and higher lows. So there's a higher high, higher low. Let's say price pushed up to have a higher high, came down to have a higher low. Okay, so here we have a higher high, higher high. Over here we have a higher low. Here again we have a higher high, higher high. Over here we have a higher low. So what price does is it pushes up again to form another higher high, comes down. Sometimes it can form a higher low or an equal low. Okay, so it'll have a higher high here. Let's say we'll keep it to equal low. Okay, but it can be a higher low, equal low. and price will push up, create a lower high, not a higher high. Why? Because price pushed down from there. So it didn't go beyond this higher high here. So we have a lower high, indicating a potential downtrend. So what will happen is price will push down, make a lower low, confirming the downtrend. So as you can see here, price made a left shoulder, this higher high, made a head, the last high. Oops, let me do this over. So if I use this tool, this high is the left shoulder. The recent high, the last high is the head. Then the lower high is the right shoulder. Now as you can see, this area here is known as the neckline of your head and shoulders. So what will happen is, once that lower low forms, price will make a lower high, and this is where you'll look to enter a sell somewhere in this area to go down, because we're no more in an uptrend. So this is basically a head and shoulders. Let me show you on the chart. Let's say here. So what happens is price makes high, low, high, 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 low, high, 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 low, lower high, lower low, retest, sell. So let me show you here. Okay, let's call that a high. Here is a low, higher high. Why? Because it's higher than the previous high. Higher low. Why is this a higher low? Because it's higher than the previous low. Higher high. This one made a higher low. And then what happened? Price never went beyond this high high, so made a lower high. And then formed a lower low, indicating downward movement. So if I take this tool again and I start here, left shoulder, head, right shoulder. Can you see here's your neckline? Look how price went down, retraced, and then you would have sold. Because first of all, market structure, lower high, telling you to sell. Because it changed from an uptrend to a downtrend, sell. Head and shoulders, break and retest, sell. So that's second confirmation. Third confirmation is this support here, which is now resistance. Another confirmation, I mean, you can put your Fibonacci, 61.8. Drop down on lower time frames, look for candlestick confirmation, and then you are looking to sell from this point to profit. So this is a head and shoulder pattern. Now your inverse head and shoulders again is the opposite now, this time of your head and shoulders. So you know your inverse head and shoulders will come from a downtrend and then it will transition into an uptrend. So you'll have your left shoulder, your head, your right shoulder, and then boom, break, hopefully for a retest rather, you know, just for risk management purposes. And then you enter a buy, and you know the high probability of that trade would be a buy. So let's go have a look at an example. Now for your inverse head and shoulders, it's basically the head and shoulders just, inverse, opposite. So basically your inverse is from a downtrend to an uptrend. So what will happen is you'll have a lower low, lower high, lower low. Then you can have a lower high equal low, right? Then you'll have a higher low. Okay, it won't go past this lower low. So if I write it down, lower low, lower low, here's a lower low, lower high, lower high, and then higher low, higher low. Then price will break past this lower high to form a higher high. So indication that the downtrend has ended. So what will happen is we'll have our left shoulder here, our head, so I'll use the same tool. So here's our left shoulder, our head, and our right shoulder. So what do we need to wait for? We need to wait for price to retest around this area and it'll form a higher low. So we would like to buy around this area over here. We'd like to buy because remember your market structure was downtrend, now it's into a new uptrend, so you need to look for buying opportunities. So that's one confirmation. Second confirmation is your inverse head and shoulders, the break, the retest. You can put your trend line. So here's your descending trend line, break, retest of the trend line. You can put your Fibonacci, 61.8%, and buy. Okay, here's sort of example here. So if you look over here, so from this point to there, lower low, lower high, lower low, higher high, right shoulder, higher low, so as you can see, break, higher high. So if we go here, so this is a lower low, here's also a lower low, lower high, then here's already a higher high. So first indication, higher low, but we have to wait. Then boom, higher high. So now we wait for this retest, higher low, and then we look for buying opportunities. Then we buy, would have profited. So that is an inverse head and shoulders. And then other reversals is your rising wedge and your falling wedge. So I already did an example of this. However, your rising wedge and your falling wedge, it can be a continuation pattern and it can be a reversal pattern. So, it can break above, continue like your rising wedge. It can break above, retest, buy, or it can break below, retest, and then you sell. So, yeah, it just depends. That's why I say, rather wait for the clear break either side, wait for the retracement, have extra confirmation like your Fibonacci, support and resistance, candlestick confirmation, and then you're good to enter whatever direction it broke out of. Your next one is your bilateral patterns. Now your bilateral patterns, okay, these are a bit more tricky because all of them go either way. Okay, it's not just like your rising wedge and your falling wedge. Um, so this is the heading where, you know, our triangle patterns fall under. So your symmetrical, ascending, etc. So when you see this pattern, you need to figure out, okay, if you look at both scenarios, how can it be a buy and how can it be a sell? So obviously the one with the more confirmation is the one you'd most likely, buy or sell. Um, Problem with these sort of patterns is they tend to have a lot of false breakouts. Meaning, let's say it breaks below, then you'll wait for a retest and then you'll sell. However, it can break below and then just go up and pass it, right? That's the issue. So now for your bilateral chart patterns, like I said, it involves triangles. So similar to your rising wedge and falling wedge, that's why both of those are considered reversal or continuation, is because mainly your triangles are either up or down. So you get three types. You get your symmetrical, ascending, and descending. So now all three can form either in an uptrend or a downtrend, and then all three can either break above, retest, carry on going up, or break below, retest, and carry on going down. Right. So be very careful with these sort of patterns. Like I said, it is like your rising and falling wedge. Um, you know, so I'm going to just draw out the examples. I'm not going to show chart examples because I mean I did show the rising wedge and falling wedge. But yeah, let me get into it. So for your sort of symmetrical triangle, the first one, symmetrical. Now symmetrical means whereby, both trend lines are sort of, the top one is a descending trend line and the bottom one is an ascending trend line. So, you'll have your descending trend line like this. So it'll make like lower highs basically. And then your ascending trend line like this, it'll make higher lows. So if price, were to come up, it'll make a higher high, come down, make a higher low, come up, make a lower high, higher low, lower high, higher low, lower high, higher low. So if I were to write it out, so the first one would obviously be your higher high. And higher low. So then this will be a higher low, higher low. Okay, lower high. Lower high. And then lower high, for example. Okay. So one of two things will then happen. Price will either break below, okay, make a lower low, retest up, so it would make a lower low, lower low. And then that's when you would look to sell after this retest. Because now, it's now in a downtrend. So basically, it'll basically, make a new sort of lower high or continue with the lower high. And then that's when you would sell because it's most likely going to make a new lower low over here, over there. So that's the first scenario. The second scenario is it can break above, passing all of this. Okay, this is just to trick you. In the paid course, I'll explain how and why. So it'll make higher high, higher high. Then it will come down to retest the trend line. Okay, let me just remove this example. And then make a new higher low. Make a new higher low. Then you carry on with your analysis, Fibonacci, support and resistance, whatever. And then that's when you will buy, because it's most likely going to make a new higher high. So that's a symmetrical triangle. Now we'll go with this one first. This is a descending triangle. Okay, so what can happen? Let's say again uptrend, right? Uptrend makes a higher high. Let me do it this. Higher high comes down to make a higher low. Then what happens is price pushes down, doesn't go higher, it makes a lower high, then an equal low, lower high, equal low, lower high, equal low. Can you see how the price is basically getting squished? So one of two things will happen. It'll either break above, make a new higher high, come down to retest a higher low, and then you would buy. Or it'll break below, make a lower low, retest. I mean, remember, this is acting as support, breaks below, retest, now it's acting as resistance. And then sell. So that is a descending sort of, triangle. Ascending is the opposite. Now this time the top trend line is basically, horizontal, and then the bottom trend line is ascending. So again, okay, I'm just going to stick with the uptrend. So up makes a higher high, makes a higher low. This time it makes an equal high, higher low, equal high, higher low. So higher high, whoops, higher low, yeah. Okay, let me just do this, equal high, equal high. There's your high low here. After the equal high, it makes a new higher low. Then again a new equal high. Then again a new higher low. So one of two things are going to happen. It's either going to push up, make a new higher high, come down, make a new higher low, and this is where you'll buy, because it's most likely going to push back up. Or it'll come down, make a lower low, retest up to make a lower high. This is where you'll look to sell. Sell. So that is an ascending triangle. So those are the market formations. Once you just start practicing, just go on tradingview.com or MetaTrader 4. See if you can start identifying these patterns, see which way they are going, see how long it takes, see the different types. I mean, like your head and shoulders, it can be level, it can be horizontal, or it can, slant a little bit. So just put in the work and try and identify these market patterns, because there's a lot of potential to, a lot of profit to be made within, market formations.